Good afternoon, and welcome to our Nonprofit Accounting and Tax Update webinar. I'm Donella, Nonprofit Practice Leader at GHJ, and I'll be moderating today's panel discussions. Joining me are my colleagues Liz, Yulia, Janie, and David. David leads our transaction advisory practice as well as our cybersecurity services. He will be first up. But Liz leads our nonprofit tax practice and is our tax expert today, while Yulia and Janie are our technical experts on the accounting side. Full bios are available on our website and in the materials that we sent out after today's webinar, along with the recording. And if you are interested in obtaining CPE, please respond to the polling questions that pop up periodically. There are 3 polling questions. And our goal today is to provide guidance and provoke discussion. So if you have questions, drop them into the Q&A together with your email address, and we will respond to them afterwards if we don't get to them during the webinar. And I believe we have our first polling question coming up. So I will give a few moments. Yes, these are all top priorities. It'll be hard to rank them. All right, before we jump into our accounting and tax update, I have a few questions for David on the topic of data security. David, with limited resources, what recommendations do you have to enhance an organization's overall cybersecurity strength and resilience?
Yeah, thank you, Donella, and good afternoon, everyone. As it relates to cybersecurity, and in particular with limited budgets, as you mentioned, there's a lot that organizations can do that come with either very little or no financial commitment. The biggest investment actually that organizations can make is more related to a cultural message of cybersecurity and really having individuals aware and take ownership of their role in cybersecurity. Unfortunately, humans are often the first and last line of defense when it comes to cybersecurity. So a real cultural message and responsibility is free of financial commitment, but also very valuable in terms of that sort of defensive posture against cyber threats. There's also several what I'll call low-hanging fruit or basic measures, blocking and tackling, that organizations can implement. For example, policies around using strong passwords, frequency of password change, enabling multi-factor authentication, wireless security, so you have to put a password in to connect to Wi-Fi, using a VPN if you're off-site, data encryption, all these things that are pretty much free of charge, but require time and or cultural view of an organization to actually take ownership of and put basic measures in place. Beyond that, there's also a ton of resources that are free, publicly available, things like publications from the CISA, which is the Cybersecurity Infrastructure Security Agency, or the Center for Internet Security, or CIS. Those organizations offer a lot of thoughts, frameworks, best practices, and it's all free of charge and readily available.
Well, nonprofits generally like something that's free,
Great.
Limited resources, so maybe you can drop those references into the chat afterwards. Just on that topic of employees and our people being the first line of defense, we do sometimes see shared logins being used as a cost-saving measure, particularly in smaller finance departments, with a mitigating control perhaps being a higher level review of quarterly or monthly financial statements. What are your reactions to that?
Yeah, shared logins pretty much across the board is a bad idea for a number of reasons. And shared logins can mean a couple of things. It could mean where for a given platform or website, there's a common password and username that folks are sharing between each other. That presents challenges with how do you control who's got access to it. If there is an issue and you need to look at logs, then it doesn't tell you who was, performing certain activities. It could also mean, just as an example, that an individual is using the same password for different sites, which then has a risk associated with it if a password does become exposed. It could also be a combination of the two, which is as you can imagine, a significant issue. So my view, and I think most cyber security professionals' view, would be shared logins is a bad idea.
More repercussions than one might imagine.
Yeah.
Who should be responsible for oversight of technology and cybersecurity? Is it the audit committee, the finance committee, the executive committee? Now, how do we make sure that the oversight and governance function in this area doesn't fall through the cracks?
Yeah, it's a great question. And I would actually go back to what I said earlier about culture. It's hugely important that there is a message that everyone has a role to play. Everyone has an obligation. Everybody has keys to the kingdom, if you will, in terms of being a potential, it's called an attack surface in cybersecurity world. So it's all the little areas where if somebody is trying to get into an organization, that point of entry. And we all, again, as humans, hold that role and hold that responsibility. Having said that, it's also extremely important that organizations ascribe the ultimate responsibility to an individual. And typically that's somebody in the executive leadership function. And typically it would be, what we tend to see is the CFO holds that responsibility. Does not mean that the CFO has to become a cybersecurity expert. It does mean that they own the obligation to train, inform, put the right controls in place and so forth. And the reason it falls to the CFO is because financial data is usually one of, if not the crown jewel of an organization. And secondly, that cybersecurity by its nature is very much controls driven, as can be a lot of the financial function as well. And so for that reason, we do see it being held often by the CFO, but irrespective of the who, it's absolutely critical that there is somebody at the senior executive leadership level who takes ownership of cybersecurity, albeit as an organization, every individual does have a role to play as well.
And David, those cyber criminals are very creative and always coming up with new ways and innovative ways of bypassing systems. How often should a cyber review be performed?
So I'll give the answer of good, better, and best. Good, which is really actually a minimum, is annually. As we all know, cyber threats emerge every single day. And there's a concept of zero-day vulnerability, which means the day a vulnerability is discovered and becomes public, then unfortunately the criminals communicate that to one another as well. And that becomes then a new attack surface, as we just spoke about. So being able to respond and update very quickly is important. Annually is the bare minimum. Better than that is semi-annually, so twice per year. Really, it should be quarterly. And that's sort of the best option. And that, by the way, is to review and assess the controls that you have. Those controls should include regular patching and patching of what I just talked about, which is zero-day vulnerability. So the day that something becomes known as a vulnerability, then there should be a very quick, and I mean within 0 to 3 days, patching of that vulnerability. Albeit separately, annually. Better than that is semi-annually, and really should be quarterly, is to review and test those policies that are in place.
That poor CFO has a lot of responsibility falling on their shoulders. We have time for one question in the Q&A, and it's actually one that we do see quite a bit, or I guess different practices. The technology function obviously can be in-house or outsourced. And what are some pros and cons to be evaluated when making that decision?
Yeah, outsourcing the IT function is relatively common, especially for non-profit organizations, and especially I would say for some smaller organizations as well. One of the main advantages of doing that is cost savings. It also gives organizations access to expertise and technology that just wouldn't be able to acquire in-house without using a third party. It allows 24/7 on-demand access to whoever that outsourced function is, especially if there's a cybersecurity offering in that outsourcing function, then that 24/7 access is important. And it also allows the management team to focus on the core business and not be distracted by IT, but knowing that it's handled by a third party and then focus on what they need to do day to day. On the other side of the coin, the organization will lose control, immediate control, I should say, over the IT function. There is communication, misunderstanding, gaps potentially between a third party and how the organization itself knows to communicate with its internal people. There's a risk of prioritization. Vendors will have multiple clients, and making sure that you have their time and attention is important. And then finally is over time, organizations will inherently develop some dependency on that third party outsource function. And so it doesn't hurt, by the way, to occasionally have a look over that IT firm's shoulder, right? From the perspective of, are things in order? Everything changes, regularly. So make sure that we're on top of that sort of dynamic environment, really with a view to making sure that if we are developing a dependency on an outsourced IT function, that in itself is fine, but we need to make sure that it's continuing to best serve the organization's needs.
Thank you, David. Those are very helpful tips. And now it's time to turn to recent developments on the accounting and tax fronts. And I believe we have another polling question.
Thank you, Danella. Let's start with the latest hot topic in accounting, which is the new current expected credit losses accounting standard update. And since that's a bit of a mouthful, you'll likely hear it referenced as CECL. The most important thing for finance and management teams to know is that this new methodology replaces the existing incurred loss methodology for recognizing credit losses. So before this update, you booked credit losses, write-offs, or bad debts once those amounts were both known and probable. So think specific identification of losses. But the new standard requires organizations to assess expected credit losses over the life of their financial assets, and then book any expected loss over the course of those lifespans. So in this case, think estimated allowance that's covering the entire balance. The update does not identify a specific method for measuring those credit losses, and the guidance actually allows an organization to develop their own methods to come up with an estimation model for credit losses. So really, an organization can leverage existing and current data in their analysis. Here we've also listed what the standard does and does not apply to. CECL applies to financial instruments measured at amortized cost. So these are exchange-based receivables, loans and notes receivable, cash equivalents, and programmatic loans. CECL does not apply to contributions receivable, government receivables accounted for under the contribution model, investments or any other instruments reported at fair value, operating lease receivables, or intercompany loans or other receivables. So we have noted a few challenges during this first year of implementation, and the main one is a resource constraint at the organization level. Because the standard requires a new financial evaluation, this of course means new worksheets, new formulas, an accumulation of both meaningful and relevant data, and really just additional time spent wrapping everyone's heads around a relatively complex new standard. And these are all constraints on top of our pre-existing resource constraints that everyone is experiencing. So given what we've seen in practice, I did want to reemphasize that the standard does not require a specific method for evaluation. So as you're implementing, it's really helpful to thoughtfully consider what meaningful data you already have access to, and then build your valuation using that as a starting point. Now let's discuss the new standard for crypto assets, which will be effective for years beginning December 15th, 2024, or after, with early adoption being permitted. So currently, crypto assets are valued using the cost less impairment model, but going forward, they'll be measured at fair value. Ultimately, they decided that the cost less impairment model did not really give users of the financial statements what was considered decision useful information, because the impairment model only ever decreases the value of an asset. And that is really not reflective of a crypto asset's true financial value. So in short, the good news is that this means that testing crypto assets for impairment will no longer be required. And now that these assets are measured at fair value, the respective changes in that value will run through either changes in net assets or your net income on the income statement. This new standard also includes additional presentation and disclosure requirements. So crypto assets now measured at fair value must be reported separately from other intangibles on the statement of financial position. And then again, the changes in the fair value of the crypto assets must be reported separately from the changes in value of other intangibles on the statement of profit and loss. And if it's not broken out separately, it needs to be disclosed in the footnote. So now the name, the fair value, and the number of units, as well as the cost basis and the method for determining the cost basis for each significant holding must be disclosed. And finally, an organization must now disclose a roll forward of activity for the year. So that includes the beginning balance, additions, dispositions, and gains and losses related to those crypto assets. And now I will turn it over to Yulia to continue.
Thank you, Janie. So now that we're all aware of the new standards, let's talk about everybody's favorite standard that we all spent a lot of time implementing last year, the new lease accounting standard. We are now a year into this, into the life with this new standard. And so what we thought we would talk about is what lessons did we learn from implementing the standard? What are the common scenarios we see nonprofits struggle with, and some important takeaways. So the first item on the slide talks about the related party leases. Under the new standard, it clarifies that leases with related entities are really treated, required to be treated as those with the third parties, unrelated third parties. So this is a significant change from the prior standard, where we were allowed to look at substance over form. Now, for all kinds of leases, whether related or unrelated, we have to look at the legally enforceable terms of the contracts and lease agreements. And so, of course, if you present those standalone financial statements for entities that are related parties, you will be capitalizing those right-of-use assets and lease liabilities. And then if you can present them on a consolidated basis, you will be eliminating those balances upon consolidation. The next item is lease term determination. This one gives everyone some headaches. I wouldn't say a lot of headaches, but from time to time we do see issues. Lease term under the new standard is defined as a combination of the four of these items. It's non-cancelable lease term, as well as periods covered by options to extend the lease or not terminate the lease if the lessee is reasonably certain to exercise those options. And when we say reasonably certain, we mean there needs to be some type of incentive for the lessee to exercise them. Maybe it's economic incentive, maybe that's where the services are provided, and that's how everyone knows where a nonprofit is. So there needs to be an incentive that it's the lessee will be reasonably certain to exercise those options. And then the fourth item is sort of unique. We don't see it very often, but it deals with the instance where that period to extend or option to extend is in the sole discretion of the lessor. So when the lessor decides whether or not to extend the lease, the lessee assumes it would be extended. So overall, when you have to think about it to calculate your lease term, you think about the maximum term that would be allowable under your lease agreement. So it's non-cancelable lease term and any options. And then think about how reasonably certain, how long would you be staying at that property, or would you be using that asset? And that's how you determine your lease term. Now, we see from time to time month-to-month leases that are automatically renewed every month with no termination date. And so there is an inclination to say, oh, this type of lease for sure falls under the short-term lease exception, where if a lease is under 12 months, then we don't bring it onto the statement of financial position as right-of-use asset and a liability. And that's actually not as easy because the same guidance would apply to those leases as well. So you would still have to go through the determination of the lease term and look at how likely and how long you would be staying at that property. And it is a significant judgment that you would have to make here, because it doesn't have a month-to-month evergreen lease would not have a termination date. So our recommendation really is to have a defined lease term in your lease agreement so that you can rely on those legally enforceable terms as specified in the contract. It makes life much easier for everyone involved. And then finally, the last item here is tenant improvements and allowances. So these are provided to the lessee by the lessor to entice them to enter into the lease. A lot of times it would include the lessor paying for a portion of the improvements that the lessee would have to put in the new property when they move in. And sometimes the lessor would pay those costs to the vendor directly. And because no cash payments are issued from the lessee, sometimes these items get missed and not recorded at all. So this is just a reminder, you do have to treat these items as part of your lease calculation. So if the lease incentive or a tenant allowance, for example, is paid prior to the commencement of the lease, you would need to reduce your right of use asset for that amount. And if it's paid after the lease commencement, then you would have to incorporate that in most cases, I should say, in most cases, you would incorporate that amount into your payment schedule, which would, again, have an impact on your lease liability. So let's switch gears here a little bit and talk about the uniform guidance. This is a topic that's very important to those nonprofits that receive governmental funding, and hopefully it will be welcome news to you all. Or maybe not news if you've been reading up on some of the guidance that has been coming out from the Office of Management and Budget. So earlier this year in April, the Office of Management and Budget did release revised guidance for grants and agreements, and it's the most significant change to the uniform guidance since it was issued back in 2013. The goal of this change was really to clarify and simplify the language of the guidance, make it plain English, and also to reduce the burden on the agencies distributing those grants and funding, as well as the recipients and subrecipients. The effective date for the changes for the revised guidance it's twofold. So changes related to the awards are effective for awards issued on or after October 1st, 2024. And the audit requirements changes are effective for fiscal years beginning October 1st or after in that 2024 again. So one of the key changes in the new uniform guidance is the increase in the single audit threshold. It's been increased from 750,000 to 1 million. So if your funding is right on the border of that 750,000, hopefully there will be now some years that maybe you will fall under that threshold and don't have to have that single audit, as it does require additional cost and time commitment. Now, I want to really emphasize here that this increase in the audit threshold would only be applicable for your fiscal year beginning October 1st, 2024 onward. So for a nonprofit with a typical year end of June, this change would not be effective for you until your fiscal year 2026 audit. Some of the other changes here, there's a lot of changes in the uniform guidance, but we'll just cover some of the more important changes, some of the key changes. The other item we wanted to talk about is the de minimis indirect cost increase. It's being raised from 10% to up to 15%. The language up to means that the indirect cost will be reimbursed still at the lower of actual indirect cost incurred, or 15%. And so if you if currently your federal agency is paying you 10%, that will be welcome news to you. You will now be getting 15% with that change. If you have a federally negotiated indirect cost rate that's close to 15%, you may want to consider switching to a de minimis rate, because there are some maintenance requirements with the negotiated cost rates, such as reapplying every few years, settling at the final rates, and so on. The goal behind this change was really to simplify cost recovery for small organizations who do not have resources to go through the formal rate negotiation process. Some of the other changes include the increase of the capitalization threshold for federally funded equipment from 5,000 to 10,000. If it's still the lower of your actual capitalization threshold that you use for financial statement purposes, or 10,000. And for small organizations out there, I would caution you not to jump straight at that 10,000 threshold, because depending on the nature of your operations and depending on the type of equipment you purchase, this amount will be may be too high for you to set as a threshold for capitalization. And then I will mention just one more item here, which is cybersecurity. You've heard David speak about cybersecurity, and we definitely know it's at the top of the mind of a lot of our nonprofit leadership teams. I'm happy to report it's also top of the mind for our federal agency grantors. They will now require recipients and subrecipients of federal funding to implement cybersecurity measures to safeguard protected personally identifiable information and other types of information that you receive from your clients, vendors, and other parties that you work with. So that's going to be in effect together with all the changes. Certainly a lot of changes, there's a lot of clarifications that will hopefully improve the life of governmentally funded nonprofits. But I will now turn it over to Liz to talk us through the tax update.
Thank you, Yulia, and good afternoon, everyone. Nice to have everybody join us today. Kicking off, talking about IRS audit trends. If this doesn't pique your interest, I don't know what else will. The Internal Revenue Service has received greater funding this past years. And with that funding, they are recruiting, they're hiring new agents, which means in turn they will be focusing and auditing additional organizations in the nonprofit area. Some key areas that they will be focusing on is areas where they could get additional revenue, where they could collect additional taxes. The first one being is unrelated business income tax. If you already have a UBI activity within your organization, you have to ensure that you have support and documentation for any direct expenses that you are allocating against that activity. If you are allocating indirect cost, ensuring that you have support in terms of the methodology that you're using to allocate some of those costs, whether it's salaries of an individual, the hours they spent, that you're documenting that. If you're using the square footage to allocate expenses or days of use, again, just having that support and backup. That way, if the IRS were to come in, you could just easily provide them with your methodology of how you are allocating those expenses. Another area to keep in mind with UBI is to ensure that you are grouping activities correctly. So there is the siloing rules that the IRS came out a couple of years back, in which you are now required to group certain activities based on what the nature is, and you could only use NOLs that are offset from that activity. And so there is a de minimis rule if you have alternative investments, NK1s, where you could kind of lump sum some of those activities. But again, ensuring that you're looking at the nature of the activities and that you are siloing those specified activities if they are substantially different. Another item to keep in mind are your net operating losses. These, again, will have limits going forward. Post your 2018, they will be limited to 80% of the taxable income. So there will be some tax due. So if you are relying on some older net operating losses, ensuring that you're keeping track of them, so going forward, you're aware of that limitation. Moving on, excise tax is another key area that the IRS will look into. This mainly impacts private foundations that are subject to excise tax. The first one being your net investment excise tax that private foundations pay. Again, ensuring that you are collecting all required K1s from alternative investments. Sometimes some alternatives are offshore alternatives that don't issue specific K1s, and then others are US-based that do. So going through your investment portfolio, ensuring that you have the K1s for the ones that do issue them. Another tax to keep in mind is the 4960 on excess employee compensation. So if you are paying individuals more than $1 million, ensuring that you're paying that appropriate tax on any of that compensation. They will also be looking at other types of excise tax, such as self-dealing, excess business holdings, taxable expenditures, and that's on on the private foundation side. Employment taxes is another focus area, and this is where the IRS could come in and look at your employee classification. For example, if you are classifying an individual as an independent contractor, when in fact they should be a W-2 employee and the organization is subject to those payroll taxes, they could come in and assess those additional taxes on the organization. So ensuring that you're looking at the roles and responsibilities of those individuals and classifying them appropriately. Another instance where this could come up is when you have, let's say, a CEO who is retiring, but they're staying on as a consultant for that transition time. So an organization may think, okay, we'll issue a W-2 and then a 1099 for their consulting services. This can be a potential red flag for the IRS if they're seeing two forms of compensation being issued, a W-2 and a 1099. So looking at the roles and responsibilities that the CEO may still hold, and they actually may still have that same W-2 role and responsibilities, and you may just want to issue them that W-2 to that former CEO, CFO. Another area would be fringe benefits that are provided to employees, ensuring that you are looking as whether they're taxable and non-taxable fringe benefits. The IRS has a great publication, which is publication 15B, which goes through various examples of different types of benefits that can be given to employees and when they're subject to tax. So, you know, if it's housing allowance, auto allowance, ensure that those are being picked up in their W-2. And then the employer retention credit is another focus area for the IRS. So just rest assured, for those organizations that claim very large ERC credits, they may be selected for an audit as well, and they will be requesting support for that calculation. Moving on to the next topic, energy tax credits. The Inflation Reduction Act is now giving nonprofit organizations allowance to actually get refundable credits for any energy efficient improvements, one being solar. So if you are adding solar panels to your property, there is a refundable credit for the cost. EV charging station or adding an or purchasing EV vehicles, the organization can actually get a reimbursement up to 30% of the cost. Again, there are various nuances when claiming the credit. For example, you do need to be paying prevailing wages if you're trying to claim the solar credit. So looking to make sure that you do meet that criteria. There are actually firms out there that we are referring some of our clients who are doing the solar credit that is a little bit more nuanced. Just because in the solar credit, you could get 30% of the cost. There's additional 20% if you're in a low income community, and there's even an additional 10% if you are using US-based materials. So the fact that a lot goes into the solar credit calculation is similar to the R&D credit, where you get an actual write-up of what are qualified expenses. We are encouraging our clients to do the same for the solar, just because that one has a little bit more of the restrictions. But the vehicle and the charging stations are a little bit more straightforward. All of these credits do require a pre-filing registration, meaning you actually have to go to the IRS website, register each property separately in which you're going to plan to take a credit. So if you're purchasing 3 vehicles, each vehicle would then need to be registered beforehand. The credit or that refund will be claimed on the Form 990T. We will need to attach the Form 3800 to claim that refundable credit. The IRS is encouraged you to pre-register 120 days before your actual filing. The reason being, it does take some time for them to give you that registration number, and that registration number will need to be reported within your tax filing. The tax filing needs to be on a timely filed Form 990T, including extensions. So you will not be able to go back and amend in order to claim the credit. The credit is claimed when the property is placed in service, so that will be your trigger to know which fiscal year of your calendar year, which year it's going to fall within, and ensure that the registration and the filing is all done on a timely basis. Moving on to other considerations, this is when we've been informing our clients about the AB 488 online contribution solicitation, which is a California legislation that was passed into law last year. And what this is doing is requiring all online solicitors, such as PayPal Giving, Facebook, all these various platforms, to ensure that the nonprofit that they're fundraising on behalf of is in good standing. And in good standing means they have to be current with the IRS, meaning their tax exemption hasn't been revoked, current with the Franchise Tax Board, as well as with the Attorney General. We tend to see a lot of organizations go out of compliance with the Attorney General's office, and this could be for various reasons. The organization may have been subject to an audit and didn't undergo an audit on a timely basis. They may have forgotten to include their federal return, whether it's the Form 990 or the 990 PF, along with their annual renewal, or they forgot to include any payment with that. So that could be a reason why you are out of compliance. And if that is the case, then they cannot fundraise on your behalf. So ensuring that you're periodically checking the websites for these various agencies to ensure that nothing has fallen through the cracks and all of the mailings and everything was received. The next topic is donor advised funds. The IRS did issue proposed regulations on DAFs, mainly as to a definition of what is considered a DAF and who is considered an advisor to a DAF. So it was a lot of definitions. The commenting period has already passed, and they actually received various comments from both practitioners and organizations in the community in terms of just areas that seem to be too narrow and captured too many things. For example, maybe where permanently restricted assets fall into that DAF definition, and I don't think that's what they tended to do with the regulation. So we may be seeing revisions to those proposed regulations. Lastly, I want to touch on your charitable acknowledgement letters. This is something I have been seeing recently where organizations are not including all the appropriate wording that should be included within the charitable acknowledgement letter. So when you are providing your thank you letter to your donors, you need to ensure that you have a specific statement at the bottom that says whether goods or services were provided to that individual in exchange for that donation. If there were none, just specifically state no goods and services were provided. But if they were purchasing a gala ticket or an event ticket, then including that direct benefit, that fair market value that they received, that would not be considered a charitable deduction, because the IRS will specifically look for that specific statement. And if it is not included, then they can disallow that charitable deduction. Another area where we see these letters kind of fall through the cracks is with private foundations. And these are family foundations that normally the individual gives to their family foundation, but sometimes that private foundation doesn't give them that charitable acknowledgement letter just because, again, they're so close. So ensuring that if you are that family foundation, that you're still issuing that charitable acknowledgement letter to that donor, to that individual, so they could have it as support for their deduction. And the last being is appraisals. You know, if you are required to have an appraisal as a nonprofit organization, or if an individual who is donating a non-cash item to an organization, ensuring that they're using a qualified appraiser. There have been cases where the IRS has disallowed the donation because the individual did not use a qualified appraiser to determine the value. So again, making sure that your donors are aware of that they are using somebody who is qualified to determine that fair market value. I will hand it back to Danella to continue the presentation.
Thank you, Liz. Gosh, after that update, it's really no surprise that many nonprofit leaders report changing regulations and compliance issues, particularly at the Department of Labor and state level, as a top challenge. And that long-awaited polling question has made an appearance. Apologies for the confusion earlier. If you were hunting around for that polling question, it is now on the screen. And actually, Liz, there was one just quick clarifying question related to the energy credits, whether there was another mechanism other than the Form 990T for claiming the credit, presumably if that, organization doesn't typically file a 990T? I think that was the question, just to clarify that.
Yeah, that is a great question. And obviously not all organizations file a 990T if they don't have unrelated business income. So no, this is the way the IRS has selected to have organizations claim that credit. So even though you don't have UBIT, you will still be required to file the Form 990T in order to claim this refundable credit.
Thank you, Liz. All right, now it's time for our second panel discussion on our favorite topic of revenue recognition. And interestingly, we noted, or perhaps not surprisingly, we noted from the first polling question that the top challenge reported by our audience members is sourcing and accessing new revenue streams. So in that spirit, let's have a short conversation about revenue recognition. So we continue to see challenges with interpretation of written agreements and applying the correct accounting treatment. So I'm going to ask each of our panelists, starting with Yulia, to give an example of a situation where multiple sets of eyes were helpful in determining the correct treatment.
Thank you, Daniela. So the example that I have is fairly unique because in this instance, an organization we work with received a grant, a fairly large grant from the state of California. It actually came in the form of check, and the only letter that was attached to the check, or the only terms that were attached, were really that it was made pursuant to a state appropriation, that the funding had to be spent for a specific program and by a specific date, and the progress reports had to be submitted. And so, you know, we're all trained in a nonprofit world. If it comes from the government, it probably is subject to some specific requirements on the spending. There are usually restrictions on the type of expenses. And let's face it, in the nonprofit world, every year we're trying to balance the budget. In this case, however, this large gift was completely unconditional. There were no rights of return. Nothing was specified as to the barriers to meet in order to be entitled to that revenue. It really just specified how to spend the funds. And so the nonprofit had to record the entire gift in the year received. And what that resulted in, as you might imagine, is that you have a large surplus in 1 year in that with donor restrictions column on your statement of activities and overall on a net basis, because this significantly increased total income for the organization. But then for the next several years, as the grant funding was being spent, you know, they would have expenses. They would release that restricted funding to cover those expenses, but on a net basis, they were running deficits. And that gave some heartburn to the management team and the audit committee on how to really tell the story about that gift to the donors and the users of the financial statements, to make sure they understand that it's not a result of not managing funds appropriately, or you know, having these continuing losses. It's really a result of how that gift was structured. Jamie, do you have a story?
I do. I also have another interesting situation. So one of our clients was notified during the fiscal year that a donor had named them in their estate and had also passed away. But at the time of the notification, the estate was neither liquid nor final settled, so there was really no actual or estimable amount known at the time of the notification. So you fast forward a bit to the next fiscal year, which is when the estate got settled and the proceeds were distributed shortly thereafter. And the situation is obviously unique and understandably a bit confusing, but ultimately, we'll go back to the events, which contributions are recorded when they're notified of the gift or when the gift is legally binding. So in this case, it was during the fiscal year when they received the initial notification. And because they now knew about the gift before the end of the year and they had the amount, then they needed to go back and record that amount into the prior fiscal year to agree to the notification date. So maybe not the exact same circumstances, but I've definitely seen many instances of that confusion over which period to record the contribution in.
We have so many stories, right? And I'm sure, Yulia, in your situation, everyone was desperately trying to find some conditions that would have changed up the pattern of revenue recognition. Just on that topic, though, of conditions, intentions and conditions sometimes get confused. So, you know, when there is language in the agreement that says up to X dollars or does not constitute a legally binding commitment, then it is more likely to be an intention to give only. And just a quick reminder on that, a condition is a requirement that the grantee is required to fulfill. So for example, if the agreement states that future installments will be dependent on the donor having sufficient resources, then that is not a condition, but an intention to give. It's got to be something that the grantee needs to fulfill. Liz, do you have any reminders for us on the tax side? I know you've already given us a lot of reminders on appraisals and things like that. So
Yeah, so just a couple, obviously these unexpected large gifts, ensuring that you're looking at your public support test to see how that is actually going to impact, especially if you're an organization that already has a relatively low public support percentage because you're receiving donations from very specific donors, looking at to the impact, working with your tax provider to do a mock-up of what your Schedule A would look like to see if you need to maybe raise additional fundings to offset that large donation and just see overall how it's going to play into your reporting.
Thank you, Liz. And with Liz in mind, I'm thinking of the donor advised funds because we're seeing more and more contributions coming through donor advised funds. So Yulia, from a revenue recognition perspective, how would you advise finance and development teams when it comes to gifts from donor advised funds?
Now, those are great questions because contributions from donor advised funds are not treated as you would probably think contributions to be treated. So just as a reminder, a donor advised fund is a fund managed by a third party, usually a community foundation or a charity, where the donor contributes to funds, gives up the control over those funds, but then makes recommendations over where those grant funds can be distributed. And so a typical scenario goes like this. A nonprofit would receive a letter from the donor that would say, I have recommended to my donor advised fund to give you $1 million in 4 annual installments for this specific program. And so the inclination is when you see this letter, that is a legally binding gift. The donor tells you they have recommended this gift. And so you would want to record, you may want to record that revenue in full, but not so fast. Remember, it's the donor advised fund now that has control over those funds. And it's only when they approve the distribution is when you would record that revenue. In practice, what most often happens is the donor advised funds would not approve the entire gift, although sometimes they do, but most often they would approve it 1 annual installment at a time. And so you would be recognizing that gift in annual installments as they would be approved by the donor advised fund. And I get asked the question, well, have you ever seen a donor advised fund not honoring the donor wishes? And no, I have never seen it. I don't think none of us have seen an instance like that when a donor advised fund doesn't honor the donor wishes. But you can't make a probability assessment that they would or would not under the new clarified revenue recognition rules that is specifically disallowed. And so you have to wait for that donor advised fund to make that approval. Liz, and I know you've shared some considerations for donor advised funds, but is there anything else, any other reminders on this?
There is, specifically on your Schedule B, if you're a public charity. I have seen it when our clients may have providing us a list of those donors. They include that donor advisor as a donor, but in essence is actually that charity that's administering, and that's who we need to list as a donor on your Schedule B. So keep that in mind that when you are recording those contributions, the thank you letter should be going to that community foundation or that charity administering, and that's who we would list on your Schedule B donor. And I also seen where individuals try to issue DAF distributions to cover maybe a museum membership or a gala event. So you need to ensure that individuals cannot receive any benefit from these DAF distributions, whether it's through a membership or gala. It's really up to the community foundation to monitor this, but you as the recipient may want to also let them know, like, hey, you should be checking on this with your DAF administrator to ensure it's you can do it, which you cannot, by the way.
Thank you, Liz. That's an important reminder. So my final question to our panelists is what tips or best practices they have related to revenue recognition? And so I'm going to ask Janie to start us off.
Yeah, of course. So my number one tip would be to provide training to your team and to keep resources readily available. So for example, like former contribution notifications or grant agreements that you've received in the past, and then maybe notes as to what the accounting treatment was for each of those situations to use as a reference for your team. We've actually have a developed revenue recognition training here at GHJ that can be tailored to specific organizations. So if that's something you think would be helpful, please don't hesitate to reach out. And on that same note, another tip I have, I would also encourage everyone to reach out to their auditors throughout the year if you have questions about accounting treatment in specific situations, or what, specific revenue recognition, or just, these unique circumstances that may come up. I promise we as auditors do love to get those emails, and we love to help with those situations throughout the year. So those are my two big takeaways.
Well, why don't I share a few of mine? So I think my first tip goes back to basics, right? It's making sure you really read that agreement that you receive and understand the terms that are included there. And if they're confusing, if they're ambiguous, something it does not make sense, and you really want to clarify, don't be afraid to reach out to your grantor or donor and have that discussion early on, so that when it's time to reconcile the books, record that revenue, close your books, you have clarity on what that gift the revenue recognition should be. And then the second tip, it relates to the communication within the organization. We often see the development department has their own goals, right, on reaching specific fundraising goals, and what they may consider a pledge or a contribution may not coincide with the gap treatment. So having that ongoing communication between the two departments, development and finance, and sending those agreements early on to the finance team will really help to ensure that revenue is recorded appropriately.
And in the spirit of communication, and we mentioned reaching out to your audit firm or reaching out to the donor, and obviously on the audit side, you've got your tax team as well. But then don't forget your legal team, because sometimes it really does take multiple sets of eyes and different perspectives coming together, particularly for the more complex gifts that you might be accessing. So that would be an important consideration too around the communication. And then we would be remiss if we didn't refer to make sure you have strong internal controls, the segregation of duties, and don't forget to reconcile your general ledger with your donor database on at least a periodic basis. That will avoid some nasty surprises during the audits, and make sure that you identify any differences on a timely basis. All right, so we are almost at time, and it looks like we have time for at least one question in the Q&A. I've picked a hot topic. Liz, this goes to Liz. With so much happening on the political landscape, advocacy and lobbying may be more important and perhaps more challenging than ever. What should be top of mind for nonprofit leadership, including board members at this time?
Yeah, so this is a great question. So just as a reminder to all that 501c3s, whether you're a public charity, private foundation, cannot have any political activities. So this means you cannot participate, intervene in any political campaign on behalf or against any candidate. So you are not allowed to do that. If you do that and incur expenses, there are actually substantial taxes that you will be subject to, or you could even lose your exemption. So that's on the political front. As a public charity, you are allowed to lobby on various matters, whether you have direct contact with a government official, if you're expressing a view, if you are in favor or against any specific legislation or proposal, then that would fall within lobbying. If you actually have a request to be an expert within something, then actually that's not considered lobbying. So just something to keep in mind, that if you have a written request to be an expert, that doesn't count towards any lobbying, because there are lobbying limitations as a public charity. You can also do nonpartisan education as long as the activities are neutral among candidates, and you don't have any preferences for or against a particular candidate. So, getting out the votes, registration, so forth, that's all allowed as a charity.
Thank you, Liz. And congratulations to everyone who's hung in throughout the whole webinar. Well done. Thank you. We're going to launch our final polling question now, so you can get your CPE. And Liz, I was just thinking also maybe a caution, particularly for those who are hosting galas and elected officials are giving speeches or receiving awards. Make sure, I guess, to vet some of those talking points in advance too.
Very good point. Obviously, you can honor individuals that are part of Congress or part of council. But again, yes, making sure that they're not saying anything political within your event. So just going through quickly just their notes that they're planning on speaking on. So very good point, Danella.
Thank you. All right, so our time is now up. A big thank you to our panelists, Liz, Yulia, Janie, and David. And for those of you who did raise questions in the Q&A, we'll address them in the email that you'll receive with the recording. Thank you so much for joining us today, and enjoy the rest of your afternoon.